Carl Ostenson here, and welcome to video 4 in our 5-part series on building your own personal pension. This video is super important because now we're starting to tie everything together. This video is all about income, and what we're going to do, we're going to show you how we go about doing an income assessment where we get all of your income on one piece of paper so you can see what all of your guaranteed sources of income look like for the rest of your life on one easy to read page. And the software we use also allows us to troubleshoot things because there's two problems that a lot of income plans have. One, their guaranteed sources of income aren't enough to meet their expenses. We call that an income gap. And two, how is the death of one of the spouses going to affect the surviving spouse's income? So let's jump over to the computer and let's take a look. So here's our example couple, John and Sally, and this is the same information we used in the 3-bucket worksheet and also the budget. So John and Sally, they're both 60 years old, and they both want to retire in 5 years at the age of 65. John's current employment income is $60,000 a year, and Sally's current employment income is $30,000 a year. When they retire, John's expected Social Security is $2,000 a month, Sally's expected Social Security is $1,400 a month, and John's going to get a pension of $1,600 a month with a 50% survivorship. So we gather up all that information and we enter it into our software. And this is what the income assessment looks like. It's all of your streams of income for the rest of your life on one easy-to-read page. And if we go back to the budget that they filled out, we know that they're expecting their expenses to be $6,250 a month or $75,000 a year when they retire. So here's the first problem. The year they retire, they don't have enough income. They have an income gap of $15,000. You can see while they're working, they're making $90,000 a year. The year they retire with Social Security and pension, their income drops to $60,000. And going back to the budget, they need $75,000 a year. So they're short $15,000 the year they retire. The second problem they have is what happens if John passes away at age 75? What happens to Sally? Well, if John dies at age 75, Sally's going to see a substantial decrease in income of $30,000 per year. Her income's going to drop from $67,000 down to $38,000 because she's going to lose one of the Social Securities, and she's also going to lose half of John's pension because there's only a 50% survivorship. So it's very important to go through this. Will the $38,000 a year, will that be enough? Will it be enough to keep her in the house? Will it be enough to make sure that she's okay? So what can they do? Well, this brings us back to video number 1 and the 3-bucket worksheet. When we sat down and asked them, at this point in your life, being 60 years old and looking forward, how much money do you want in yellow, how much in green, and how much in red? And to review, yellow is typically your bank money, your liquid money that's safe and you use to pay bills. Your green money is your protected growth and your personal pension money that'll guarantee you income for the rest of your life. And the red column is your red risk money, things like mutual funds and stocks and all that. So they said at this point in their life, they want 20% of their money in yellow, 50% in green, and 30% in red. But when we actually filled out the worksheet, here's what they actually had. They had 30% of their $500,000 in yellow and 70% in red. They didn't have any money in the green column. So let's take a look at what would happen if we just set things up how they said they wanted it going forward. That would involve switching around some money from the yellow and red and putting some money in green. If to get their desired percentages, that would be $100,000 in yellow, $250,000 in green, leaving $150,000 in the red column. Let's see what that would look like. So what they're doing is they're going to set up their personal pension, and they're going to move $250,000 into a hybrid annuity. They want to start the income in 5 years. They want the income to be joint, meaning there's 100% survivorship, so no matter how long either one of them is alive, they know that they have income for life. And then if there's a remaining balance when they both pass away, they want that balance to go to the kids. So now we've added another column onto their income assessment, which is John and Sally's personal pension income. So here's the retirement income when they start at age 65. Now you can see, instead of only getting $60,000, which wasn't enough to meet their bills, they're going to be getting $77,420 per year because their personal pension, starting in 5 years, is going to pay them $17,420 a year for as long as either one of them is alive. And as far as the second problem goes, as far as John passing away at age 75, the income will still drop, but instead of dropping to $38,000, it's only going to drop to $56,000, which is a lot better than $38,000. So here's what the income assessment does for you. It helps you solve problems. And in John and Sally's case, now they have less money at risk because they moved some money from the red and put it into the green. We solve their income gap problem, so the income they'll get when they retire is enough to meet their expenses. Sally's in a much better position if John dies at age 75, and they're able to see all their income for the rest of their life on one easy-to-read page. And here's the benefit of doing something like this before you retire, or doing it now versus later. Because the earlier you do this, that equals more income when you finally need it. At this point in their life, while they're 60, $250,000 in one of these plans will pay them the $17,420 per year that they need. But if they wait 5 years to set one of these up, it'll take $350,000 to pay out that same amount of income of $17,420. So in 5 years, they'll need $100,000 more to get the exact same income that they can get if they set it up now. If you're like most people that have made it this far in the video series, odds are pretty good you might have some thoughts or concerns of your own regarding your own retirement. And maybe what we've been talking about is getting the wheels spinning a little bit, and you realize you might have to make some changes or switch some things around in order to make sure that you have a safe and secure retirement going forward. So here's what I'm willing to do as a bonus for making it this far. I'm willing to do a full-blown income assessment like you just saw in the video for you for no charge. Why would I do that? It's really helpful, and it's a good thing for people to see all their income. And I know not everyone becomes a client, and there's no obligation, and that's fine. But I also know if I provide a lot of value and I show people how these things work, that some of you will become clients. So that's why I'm willing to do it for no charge. So if you want to do that, I need some data from you, and there's 3 ways I can get it. By far, the easiest way is just click on the yellow box below. That'll take you to my calendar, and we can schedule a time to chat on the phone, and I'll get all the data that I need. That's the easiest way. If you don't want to do that, there's 2 other links below. One, you can print off a form and fill it out by hand and either scan and email it back to me or mail it to me. The other way is to click on the online form, and you can fill out a data form online, and that'll enable me to get the data that I need as well to do your income assessment. So stay tuned for video 5, and that one we're going to talk about how these personal pensions and all the different types of annuities, how they actually work. So we'll see you then.